H.M. Gartley's book, Profits in the Stock Market, the Gartley pattern is on page 222 of that book, originally called the Gartley 222, and later became known as the Gartley pattern. The chart below is a diagram of the Gartley pattern, showing the XABCD pattern structure without any Fibonacci ratios. So we have a X, A, B, C, D. The Gartley pattern is the foundational work that is associated with harmonic patterns. Bryce Gilmore, who was a friend of Larry, had introduced the butterfly pattern, and soon after Scott Carney had also coined the names and applied price ratios to the bat pattern, the alternate bat pattern, the shark pattern, the crab, and the deep crab patterns. The essence of all harmonic patterns is the X, A, B, C, D relationships and ratios. The concept behind the Gartley is a retracement within the larger term trend. Odds favor success when the market retraces down from an uptrend for a bullish Gartley pattern as opposed to a bullish Gartley pattern within a downtrending market. Conversely, the bearish Gartley would be ideal to short a retracement up in a downtrending market than to short an uptrending market. In an uptrending market, traders seek to buy retracement down, and in the downtrending market, traders seek to short the retracement up. In this example, we see the structure. I highlighted the 0, 1, 2, 3, 4, 5. This is what we call an Elliott 5 wave. And in an Elliott 5 wave, you tend to get that fifth wave and then an A, B, C corrective wave down. If we look at this in relation to harmonics, it's essentially the same thing, okay? So what you're doing is, with the harmonic pattern, you're buying the retracement within an uptrending market as opposed to try to buy the bottom of a downtrending market. So same structure as you look at it on an Elliott wave, you see in the harmonic wave where you have the same coordinates. We plotted the Elliott 5 wave to highlight the proper corrective wave structure. However, looking at this in a harmonic view, we see a clear Gartley pattern structure. This increases the odds of the pattern. Buying the retracement in an uptrend, and retracement is the D completion point. Most mistakes we've noticed from viewing work on websites, social media sites, and sites where individual traders post their work is not the pattern itself, it's the location of the trend. Just because the pattern is showing a perfect structure, the higher time frame pattern needs to be in a corrective mode. But many times the A point is normally the retracement of the downtrend, and the D point is just the midway between the ensuing leg to the downside, causing the pattern to fail. You see, let's just say we have a downtrending market where you're looking for that ABC up, where you get that Gartley pattern up for a short, where most traders think this is a reversal pattern, when in fact it's a corrective pattern within the structure of a trend. Now we understand it's better to buy the pullback in an uptrending market and sell the rallies in a downtrending market, and that a trend is a friend. We can proceed to look at Fibonacci structure for the Gartley pattern. When looking for a Gartley pattern, we need to see the proper structure from X to AB, B to CD, and XA to D, and we'll lay this out step by step. The first step is the impulse leg, as you see on the screen. This is an impulse leg. The market rallies. This identifies the XA structure, and the ensuing leg creates the B. The retracement leg from the X low to the A high is the B point of the structure. The chart on the screen shows the B retracement. However, the B point will retrace 618 of the XA. Hypothetically, if this was 0 and this was 10, okay, this would be 6.18. So X, A, B, retracement from that prior leg down. The diagram shows the retracement from X to A leg to B. The next leg of the structure will also be a retracement leg. However, this will be a retracement up from the AB leg to the downside. The Fibonacci zone will be a minimum of 38% retracement. So from A high to B up 38% minimum to a maximum of 886. This plots the C point. When looking at the Gartley pattern, the next leg down, which creates the ABCD leg that completes the ABCD pattern, while the Gartley pattern is the most important. The XAB is 618, so XAB is your 618. The ABC is 38 to 88%. Then the BCD leg will have an extension from this range here, just like this, of a minimum of 1272 to a maximum of 1618. And then the XAD, which means the X low, the A high to the D has a 786 retracement. This is considered the completion point of the pattern. Now that we understand the structure of the bullish Gartley, the D completion point is the entry point to buy. And your risk is right below the X point, or 103%. So which means that X is the low, A is the high, 100%. If it was to retrace all the way down, it would retrace 103%. That would be your risk point. So entry point and risk point. When the entry and risk points are identified, we seek to exit at targets 38%, 618%, and 100%. So let's just say you bought the market here. The market trades to this point. You can exit, or you can exit here, or you can exit here. So if you bought multiple lots, you could scale out. If you bought one lot, you can trail a stop. For instance, if the market, you bought here and the market went to 38%, you could bring your risk to here. If the market went to 618, you could bring your risk to here. You see, it's up to you at that point, but if you have multiple lots, you can scale out on the way up. Okay, what we're showing is we show an example of a Gartley pattern showing the entry. We hid the time and price and symbol to show that this applies to any market, any time frame, from 1 minute chart to a weekly chart, from corn to currencies. So essentially, this is an actual chart, a price bar, showing you your entry, your Gartley structure, and your targets. We suggest to practice with a variety of charts, different time frames, symbols, and markets. Make this a fun experience that turns into a methodology you can create profits from on a consistent basis. Once you have identified the higher time frame trend, the retracement zone, and then the harmonic pattern, whether it's a Gartley, a butterfly, a crab, or just an XABC that you have found to have proper Fibonacci ratios with binding geometry, you'll be on your way to success using these patterns. My name is Christopher Terry, and thank you for watching the video on the Gartley pattern. In this example, we will look at the butterfly pattern, and instead of looking at the bullish pattern, we're going to look at a bearish pattern. The butterfly pattern is also an XABCD pattern. The difference with this pattern as opposed to the other ones we had looked at is that the X to A has a retracement to B, and it's a deep retracement up of 786 or 7.786% of 786% of the prior swing down. From B down to C, the market goes between a 38 and 88% retracement, and then that next drive up is where the market gets to that extension leg. B, C extends to D, X, A extends to D. Important to look at the 1272 to 1618. Bryce Gilmore designed the butterfly pattern, and it was 1.272 became the factor to use, although some people do use a 1.618. Let's take a look at an example on a drawing, and then let's look at a live example. Let's look at an example again. We draw it out, and let's just take this as a bullish run. This being a swing low, this is being a swing high, and we're looking for this whole retracement down. If we take a look at the butterfly pattern, the market will have its X point here, its A here, and then you have its retracement down of 786, its move up. So if we look at this like that, and then one more time to the downside. This is where the butterfly pattern comes into play, because we have the extension from X, A, B, C, D, and this being the D point. Sorry, this is being the X point here. This is being the A point. B, C, D. This would be the extension from the swing low on the prior market swing to highs down. So from here to high down, that's that 786 retracement. So when the market puts a lower high in and you get the final drive to the downside, this is what traders look at. We look at this point right here, from X to D and from BC down to D, and that sets up the butterfly pattern. We tend to see this in a trending market, the strongest in a trending market, because after the market has a strong run up, sometimes it does need a deeper retracement. And in that case, this is where we find the butterfly pattern in a bullish structure becomes extremely powerful. The reverse is true for a bearish pattern. Let's take a look at a live example. In this example, we will show the butterfly pattern. And then we're going to discuss variations, and we will explain that. Let's first start with a swing high and then a swing low. If we look at the the butterfly pattern from the high down to the low, market then makes its retracement up, which is 786 of this swing down, has that drive down, which is at 382 to 886 of that prior swing, and then the drive to the upside. And that drive to the upside would have that 1272 extension from the X up. So let's take a look and redraw this. We're going to lay in Fibonacci levels. So from here, straight down, and we're going to see where the market did retrace up towards the 786. It didn't surpass it. So right in this area right here, and sometimes it's okay to be a little bit short or right around the zone. Doesn't have to be exactly perfect. Pass it. This is the last center. It's this look at it's up. In this example, we will look at the butterfly pattern, and instead of looking at the bullish pattern, we're going to look at a bearish pattern. The butterfly pattern is also an X, A, B, C, D pattern. The difference with this pattern as opposed to the other ones we had looked at is that the X to A has a retracement to B, and it's a deep retracement up of 786 or 7.786% of 786% of the prior swing down. From B down to C, the market goes between a 38 and 88% retracement, and then that next drive up is where the market gets to that extension leg. B, C extends to D, X, A extends to D. Important to look at the 1272 to 1618. Bryce Gilmore designed the butterfly pattern, and it was 1.272 became the factor to use, although some people do use a 1.618. Let's take a look at an example on a drawing, and then let's look at a live example. Let's look at example again. We draw it out, and let's just take this as a bullish run. This being a swing low, this is being a swing high, and we're looking for this whole retracement down. If we take a look at the butterfly pattern, the market will have its X point here, its A here, and then you have its retracement down of 786. Its move up. So if we look at this like that, and then one more time to the downside. This is where the butterfly pattern comes into play, because we have the extension from X, A, B, C, D, and this being the D point. Sorry, this is being the X point here. This is being the A point. B, C, D. This would be the extension from the swing low on the prior market swing to highs down. So from here to high down, that's that 786 retracement. So when the market puts a lower high in and you get the final drive to the downside, this is what traders look at. We look at this point right here, from X to D and from BC down to D, and that sets up the butterfly pattern. We tend to see this in a trending market, the strongest in a trending market, because after the market has a strong run up, sometimes it does need a deeper retracement, and in that case, this is where we find the butterfly pattern in a bullish structure becomes extremely powerful. The reverse is true for a bearish pattern. Let's take a look at a live example. In this example, we will show the butterfly pattern. And then we're going to discuss variations, and we will explain that. Let's first start with a swing high and then a swing low. If we look at the the butterfly pattern from the high down to the low, market then makes its retracement up, which is 786 of this swing down, has that drive down, which is a 382 to 886 of that prior swing, and then the drive to the upside. And that drive to the upside would have that 1272 extension from the X up. So let's take a look and redraw this. We're going to lay in Fibonacci levels. So from here, straight down, and we're going to see where the market did retrace up towards the 786. It didn't surpass it. So right in this area right here. And sometimes it's okay to be a little bit short or right around the zone. Doesn't have to be exactly perfect. The other spots we want to watch, we can clearly see that this is between a 38 and 88% swing from here. And then we have the push up to the 1272. Clear as day. So we're looking at the X down to A, up to B, down to C, up to D. And if we put the labels in there, Here's your X, A, B, C, C. This creates the butterfly pattern. Now, since this is the last example, we want to expand on this because the question always becomes, well, how do you know where to pick your targets? So we're going to get to that in a minute. The last thing we want to go over, and I apologize, is from C to D. From C to D, we're going to look at levels of retracements of targets. Now we do have to remove some of this other stuff. Okay. And typically what I like to do also is, although this is a 1272 extension, I like to keep my stops up at 1618, at a 1618 extension up here. You want to keep them wide enough because in case there is some additional play around the level. On the way down in terms of targets, you have your 38, you have your, sorry about that, you have your 618, and then you have your 100% target. In this example, it did not reach 100%, but we did see it reach 38%, 62%, and as a trader, you would trail your stops. When you have your initial trade, your stop goes 1618. When it goes down to your first target at 38%, you take off part profits. Stop is here. It hits your next target, and you lower your stop. Always good to trail your stops. Now, let's take a look at the other question was, how do you know which pattern to use? How do you know where to pull your high or low? So let me clean up the chart. Okay, we are going to extend this last video, and we are going to go through where do you know where to pull your targets from. So if we take the high to low, we could see actually that this has formed the potential for a bat pattern. Market high, market low, 38 to 50%, 382 to 886, and then up into the 886. That would be considered a bat pattern. That would be the first big pattern to watch. Then we have this high to low here, and we're going to point that out in a moment. Okay, we are going to remove the Fibonacci levels from this high down to this high, and now we see the same move down. If you take a look here, we have the first retracement up was a 618 from the market high to market low. We will draw that in real quick. Market high, market low, 618. This sets up the potential for a Gartley pattern. And the Gartley pattern arrives at the 786. So the Gartley pattern was tested in here, and essentially the market may have come down a little bit, but also went and tested the prior highs. This is why we like to put our risk above the market, because the market stays valid until it actually fails and continues up. So this actually would have stayed valid, or a trader would have been able to re-enter the market. So what we're going to do is erase the arrows. Going to erase the arrows. and we're going to draw in the other pattern. So as we see right now, before we get to the butterfly pattern, we already have two patterns within this whole structure. Now we're looking at this lower high because this, now the market has made a lower high, pulling the structure down, pulling the pattern down, and we see that it made a 786. So what we're going to do is we're going to change the picture a little bit, make it blue, and we're going to set the default so we could see that. That next swing, which we looked at in our prior example, all right, and then came up to our zone. If we take a look at the Fibonacci ratios, as we did in our prior video, right here, we see that you have overlapping patterns, but in this particular example, you had the butterfly pattern within the structure of a larger bat pattern. This is valid, and it's a good way to look at the markets. You don't always have to look at one particular pattern. Many times patterns overlap each other, and you have that higher time frame confirmation. So here's an example. We gave an example of the butterfly pattern, and plus we gave an example of how you can use multiple patterns within one structure and be able to time the markets properly. Thank you. Hi, my name is Christopher Terry, CEO of iMarkets Live, and I want to go over some entry techniques, which is a good way to enter and which is a bad way. We have two examples, the EUR AUD, and we have the EUR GBP, not that one, the EUR GBP, there you go. And we're going to look at both scenarios, and I'll show you some entry techniques. The goal is that we always stay on the right side of the market and not to take too much risk. If you looked at my other videos on the website, you'll see that I went through some entry techniques, and there's no reason to have such a wide risk. I don't particularly do that. I don't expect anybody to do that. I like to take trades with the smallest of risk. Now, if you want to do a wide risk, that's fine, but I'd rather you have some entry techniques, and if you watch my other videos, it goes into it. So let's look at this now. Let's take a horizontal line and emulate the entry area, and I could look at the lower time frame. Let's go down to an hourly chart. Okay, let's go down to an hourly chart. So a couple things we could look for. Number one, here's your rally off of the low. All right, here's your rally off of the low, and here's your pullback. What I like to do is I like to look at pullbacks. I like to look at a rally off of the entry zone or entry area if it pushes in and then comes back up. I like that. I like to look at entries. Sorry about this. Let me just fix this. Okay, MetaTrader 4. Let's just do this. Try that again. So I like to look at entries on pullbacks after the market goes down. Now, we did a couple of them, actually. This right here, we actually looked at in the live room, and we took that pullback. And it gave us really not much action, and we ended up breaking even on it. All right? We took that break even. Point is, this was set up as an entry area for the scanner on the higher time frame, and then when the market moved down, the scanner is following it down. It's still repainting it. That's what it's supposed to do. When you hit your entry area here, one of two things. Number one, you could be aggressive and enter there. There's nothing wrong with that. Or you could wait for a bounce and then a pullback. And in this instance, what I like to do is I like to put a stop right below the market. Okay? this would have taken a stop out. All right, you would have bought the pullback. It would have taken a stop. Had this market shifted, all right, had this market done this and back up, I would have once again looked at the retracement again. However, this went sideways and down, all right, and a lot of risk on the table. There's no need to put so much risk on the table. I like keeping my entries tight. Even though it's a higher time frame, you want to be able to enter into a lower time frame trade. That eliminates your risk. There is no need to take all this risk when you can sit and wait for that higher time frame to set up. Oops, I just did something and erased it. You wait for that higher time frame to create the pattern, and then you wait for the lower time frame to enter in, okay? So I just obviously just erased it. So not a big deal. Let's look at, okay, here it is. So I would have rather taken a small little pullback, and if it failed, so what? I could always wait for it to go up. But to take a huge move like this to the downside, it's not a good thing. You don't want to do that. You want to keep you got the higher time frame and you keep the lower time frame entries in your favor. Let's look at another example that we had in the live trading and educational room this morning. Let me get rid of this rectangle. And let me get rid of this. Okay. So let's take a look at the EUR GBP. This morning, we looked at the fact that this market hit an entry area right there. And now we watched it bounce. Let's go down to the smaller time frame. I want to show you something. I'm not going to show you that. Okay. So when this market had first hit the zone was down here. All right. Okay, this is the first time it hit was down here. Market rallies, market pulls back. We took the buy on that in the live room. Market ended up going up, fine. It came back down again right here. Came back down again right here. So we waited for it to run. You got to pull back. You could wait for that, and it runs. I'm showing you the difference between being patient and not being patient. One more time. Market hits support, bounces, pulls back, right? You see that? One more time. Market pulled back to support. Now this, so you remember, this whole area down here of support. You see that? I don't like jumping in. I like waiting for the market to give us these little pullbacks. Sorry for my voice. Then the market rallied, and now you have a pullback. You see? If we go to even lower time frame this morning in the live trading room, we looked at this. Okay, we looked at this. We looked at this. We looked at this. And this pullback for a buy. Okay? And we watched and see if it can come higher, and the market had a pop. Even if you were able to take a little bit, great. But our next play was that potentially this can happen. Okay? Let me see here. Market can have an A, B, C correction. We also were looking for a pullback in this whole trend. Okay, like that. We basically were looking at roughly, if we took the Fibonacci swing low to high, a 38 to 50% retracement here. All right, so we had discussed this in the live room today, that because the market started impulsing, we could have a retracement 38 to 50% on a pullback. It gives the opportunity to buy. You're not trying to buy down here
and try to catch the turn. Let the market move, because if we look at the higher time frame, and forgive me, it's all messed up. If this market's going to go up hundreds and hundreds of pips, you don't want to risk hundreds and hundreds of pips. That's where the edge comes with having the harmonic scanner. Think about this. First play, bang, buy, comes down again, buy, comes down again, buy, comes down again, you pull back, buy. You have multiple entries. If this market's going to go up, 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 every time you're pulling back, you're buying it. But you're not doing what we looked at on the other chart, is you're just buying blindly. You see right there? Right, there is no reason. Nothing is telling us that there's a shift in momentum. Should this had done this and then done this, fine. We could do that. Here, see? All right? You want something where you're putting that pullback. But when you're in such a deep, weak trend, you don't want to. This is called buying a falling knife, and you can get yourself into trouble. We don't want to do that. Let's take a look at a couple of other markets here. All right. So now you got the GBP AUD reaching down. Here's what I'm doing. I'm looking at where this market's going to stop going down and turn up. So let's, for instance, look here. What I would like to do, remember, here's your risk, right? That's if you're actually risking. That's just the pattern risk. I want to see this pop up. I'm not worried about the targets. I want to see it pull back, even if it's here. I want to see this pull back and give me an entry, and then put my risk underneath the market. That's how you have a low risk into a much higher time frame. EUR NZD. Here we go. In first glance, it looks like a buy, right? Let it go. Let it bounce. Go down to your lower time frame. Even go down to a 15-minute chart. All right. You wait for the market to shift, back up, and then back down. These are key entry techniques that I use. I've been very successful with. Once you get your pullback, you do that. The market always does it. Look, comes down, right? Always does it. Have your rally, have your pullback. All right? It always does it. All right? Even here, off the low, pull back. Okay? You can then manage what happens from that point, but you're always going to get that. Let me see EUR-JPY. What do we have here? Okay, we're in support on the EUR-JPY. Let's go to the 15-minute chart because it's a lower time frame. All right? Let's let this come up a little bit more. Let it come up more. It's still deciding if it wants to go up or not. Once it goes up, then you can worry about the pullback. All this data down here, all this, if it holds, this becomes what's called value. It becomes a support. All right? I want, when you guys are trading, or guys and girls, when you're trading with the scanner, to have respect for the market also. Let this go up, and let it pull back. This is going to be a natural support down here. All right? Same thing. You see it all the time. All the time happen. All right? Get used to it. Get familiar with it, because that's how you really want to trade these markets. You don't want to just jump in arbitrarily for no apparent reason. Same thing to the short side. See the AUD JPY? There's no reason I would want to trade this right now. What I would want to see, and this is on an hourly chart, I want to see this. I want to see this come down, okay? And then get a bounce. And then look for a shorting opportunity for another move back to the downside. All right? I'm sorry if there's some background noise. There's another meeting going on, and I'm in my office. So, real important, guys, real important. You want to take the time and let the entry techniques work. You don't want to just rush into a trade because it hit the zone and feel you miss it. You know, the scanner gives you so many opportunities. If you keep your risk on such a shorter time frame, but with the bigger time frame pattern, let me ask you, more times than not, you're going to succeed. This is how you catch 100, 200, 300 pip moves, 500 pip moves with the risk in 30 or 40. You see? That's how you want to play the game. Think about this. If you risk 20 or 30 pips or 40 pips 2 or 3 times and you hit one for 300, you see how that works? Most traders think, I'm gonna risk 1 to win 2 or 3. I'd rather you risk 1 to win 10, all right? 1 to win 6 or 7. That's the best way. The scanner to me is an ATM machine. It's a money pit, not a money pit, a money machine that just keeps on giving us opportunities. But you have to be on top of it enough to know you're not just going to jump into things. I'd rather you guys take these trades. Let's take a look here. Let's just take a look at what happened. Here's another thing. You don't always have to wait till it comes down here. All right? When that pattern starts drawing and you see the shift, I'm all over this. If you're in the live room with me, you know. Let's just take this right here. Remember, the size of the time frame is high. This went up. You feel like you missed it, right? You're getting that pullback. Most of the time, you get that 38 to 62%. You get your Fibonacci, you put it up, you're right in the zone. This is what I like to do. And you see how where you could put such small risk in place. You're defining the fact that it stops going down, it rallies, and this pullback here, that's what you look in the buy. Anywhere in here. And look at the size moves you get. So if you think about, you risked, what was that, 30, 40 pips, and you're up 150 already. You see, that's what I like to do. That's how we play the game. Don't feel you need to just jump into a falling market because this market's falling. No, you let it pull back. Now, if you get a bounce like this and it pulls back and you get stopped out, so be it. You wait for the next one and you wait. All right? You keep waiting for that shift. All right? You can see that. All right? So, anyway, I thought I'd make a quick video. Entry techniques. Be patient and just be patient. You'll see how simple it is and keep your risk at a low. All right? My name is Christopher Terry. Thank you very much for watching this video. We are now going to discuss the shark pattern. Designed by Scott Carney, a harmonic expert. He designed it with an X, A, B, C, D, as all harmonics are, with an X beginning and a D ending. And in this example, from X to A is the impulse leg. The A to B, there is no retracement value needed, but the other criteria is when you have A, B, up to C, it can fall between a 1.13 and a 1.618 extension. From the B to C down to D leg, it's a 1.618 to a 2.24 extension. And then important is the X to D leg, the retracement. This turns into both a retracement and an extension at the same time, and we will see this in a live example.
The retracement is an 886 to a 1.13 extension. Let's take a look at a drawing, and then we will look at a live example. In our drawing, as we discussed in the past, and we will continue to discuss, is that bullish harmonic patterns are best purchased when the market has a retracement in a bullish trend. However, we do want to look at how these patterns can work. So in the shark pattern, you have your retracement down. Okay, so if we're looking at this in an uptrending mode, okay, well, let me just fix that. In an uptrending mode, you have your retracement levels. What we do see here is, for instance, you have a little retracement and then up. In the shark pattern, the market makes its high, and we'll draw this in another color. Market makes its high, has a retracement, then makes a higher high, and then makes a retracement down, and then possibly an extension. So just looking at this at face value, it doesn't really look as much as a harmonic as the other ones do. So let's just draw it in. We have that little swing low. We have the first retracement. We have the higher high. And then we have the retracement down. Now, when looking at harmonics on the shark pattern, typically right here, this being the low, the X, we would have a retracement of an 886 to an extension of a 113. So if we were to label this, we would have an X, A, B, C, and D would have two entries, D, D. And this would give us our shark pattern. Let's take a look at a live example. Before we continue, we are going to show you a live example of what we have been discussing in terms of a trending market and why we want to go with the trend. As we see, the larger time frame trend has been down. And in this area right here is where we have our shark pattern on a smaller time frame. So we are looking for a retracement up in a downtrend and then looking for the harmonic pattern. Let's erase this data and show you on a smaller time. Okay, let's check this on a 15-minute chart. I should make it a 30-minute chart. And we will show you the shark pattern. Okay, what we are looking at here is the basis for the shark pattern. We see the market had a high, and we're going to label this out. We had an X. Oops. A. B. C. D. We look in the first leg down that the market went from high to low and then a retracement up. Now from that point, the market, we look at that ABC extension and we see it hit a 113. and then up to this D point. The D point, which we're going to discuss going forward, will have that range of the 886 to the 1618 to the 113. As we see in the attached example, the market went from X down to A, has made a retracement back up of that XA swing between an 886 retracement and a 113 extension. This completes the pattern for the shark. X, A to B, and down to C is a 113 extension. And then the move up, which gives us that XAD zone for a shorting opportunity. Your risk typically would go around a 1272 extension. And what we are showing now is your risk point at a 1272 extension and your targets from C to D, down 38%, 618%, or even 100% to the downside. Those would be targets. This completes the shark pattern. All right, so we're doing a class, real quick class. All right, we're doing a real quick class. Dave, one of the guys in the room had asked me if this was a triangle right here. And in face value, it looks like a triangle, obviously, right? It looks like a triangle. It looks like you have your point, you have the two ends. It does look like a triangle. But when you're looking at a triangle, there's a structure that has to be included with it. So if we were to take, let's just take market goes down, and what we're going to do is we're going to draw it in pink. So we'll do something like that. Okay, one, okay, you got this, okay, then you got this, okay. So when you look at a triangle, you want to make sure you have multiple data points. You want to have at least 2 data points on each side. Okay, you want to have at least 2 data points. Let me just stretch this out a little bit. Okay, for instance, something like that. Okay. And let's just change the colors. Okay, we'll change the colors. So let's take this particular part right here. This is your starting part right there of where the swing that created the, like for instance, this could have done this, okay? The market could have done something like that, all right? And then we take the end point of where the trend line touches across the data points, all right? So across these data points, that's where your trend line hits, all right? And what I like to do is I like to take the Fibonacci time zone, and I'll take it from 0 to the end where it's 100%,
right where it's 100%. So if you look at it, you have 0, 100, and then I take 75, right there. I take 75. I'm not sure I can make these things bigger or thicker. I'm not sure. Let me just see. No, you can't make the numbers bigger. So in here is 75%. So when you're looking at right here, when you're looking at a triangle, right here becomes the most important component of it, the breakout zone. You're always looking at price and time. So David Marcy, we're always looking at price and time. You follow me? Price and time. So you're looking at this market, okay? You're looking at the market. For instance, this could be any market. It could be stocks, could be forex, could be futures. It doesn't matter. And you know that it's created these data points. So you got to look at them and let's count. Let's count the first one. This is data point 1. That's 1. 2. Right? You got 3. You got 4. And then you got 5. Okay. Now, in some circles, guys that like to do this type of work, they're going to tell you it needs 4 data points. Essentially, all right, if you're looking at this, you have the 4 data points that typically are needed or required. So these data points are really the most important. And then you're looking at the zone where time has to come in play, okay? Remember, there's always price and there's always time, all right? So when you're looking at the symmetrical triangle, you're looking for a breakout point, and you're looking at that point right there and this point, okay? You're looking at these 2 points right there. These 2. So you have 1, 2, 3, 4, 5, and then it's going to chop, and then you're looking for a breakout. You're looking at these past 2 swings here. If that's wide, you then take the smaller swing, okay? You could then take the smaller swing and do that. All right, so you're looking at that, something to that effect. This can have at least 5 data points, even more. It doesn't matter. You're looking at 75% of the triangle before you would have an anticipated breakout, up or down. Up. Okay, blue is up. Turquoise, blue. Blue is up. And red is down, okay? Okay, so you're looking at 75%. That's when the pattern matures. You have the multiple data points, 1, 2, 3, 4, 5, and right here, 75% into it. That's where you have where the pattern matures, and you're anticipating a breakout. Now, what you want to also do is you take the middle of this channel, the middle of the triangle. You see that? Guys, you all watching me, or you're greeting each other? All right? So pay attention. Right here, the middle of the pattern. Okay, the middle of the pattern. So when this market, if it's to trigger up, say it goes here. Okay, your stop, David Marcy, your stop is right here at the middle. Okay? Okay, it's right in the middle at the apex. All right, you follow me? There's rules to this shit, man. Like Biggie said, there's rules to this shit. All right? Most people don't understand this. They don't get it. Okay? This is levels, man. So you understand, when you look at the market, you have to put the structure there. And you have to be methodical. So if in fact it does hit this particular price point, all right, you then are buying and your stop is in the middle. The price should not come back to the middle whatsoever. If it does, then what you have, right? If it does, right? Sometimes it'll do that, and this will happen. You'll get a failed breakout to the other side. Okay, if in fact that happens, you then want to become doubly aggressive down here. So if the first price fails, when it comes down here, you want to be doubly aggressive. You follow? Doubly aggressive, because what they call is a fake out breakout. Okay? All right, that was something my mentor had coined a long time ago. So if it goes to break out and it fakes out, it most likely will come out the other side more aggressively. However, if in fact it does break out to the upside, the first pullback is always also the best to enter into a trade. So for instance, let's just say it broke out and you spotted it. You wait for that first pullback. Okay, well, you know what? Breakouts become very noisy if you're not waiting for the maturity. You gotta wait for that pattern to hit around 75%. After 75%, it gets so tight. It's like one of those pressure cookers. So it gets so tight, and then it's boom. So yes, for any market, this is any market, okay? This is any market. So what you're doing is, if in fact you don't want to buy the breakout, you let it break out, and that first pullback is your buy, and your stop is, of course, right at the middle of the triangle. All right? So, okay? So the longer the line, the longer the flight, okay? So, longer the line, the longer the flight. Now, a lot of people try to look at measured moves off of a triangle. But when you're coming out of a sideways line, a consolidation, when they break out, your job is not to sit there and go, well, let me get out. Okay? Because you guys saw last week we did trades where they were breaking out and we were buying them or selling them. You don't want to get in front of that. When they go, let it go. Let it run. All right? So your job is to monitor the data points. Once it breaks out, you have the choice to buy it with the stop in the middle. If in fact it breaks out and you miss it, you just look to buy the first pullback with the stop right down here also. And then look for that 5 wave to come in that we always talk about. You know, the Elliott 5 wave, guys, we always talk about that. A lot of times you won't get it this pretty. Okay? A lot of times it won't happen this pretty. What will happen a lot of the times, guys, is you get a breakout and it'll run. There's no looking back, okay? So a lot of times they'll just run, and what you're going to get, and make sure you take a note of this, shallow retracement, shallow retracement, right? Shallow retracement. Okay, what this ends up becoming, okay, let's just draw this out here so we're all on the same page. This is triangle breakout. Triangle breakout. We did trades, guys that are coming on new right now. We did trades this morning in London. We gave 3 big trades, about 200 pips worth of work so far. They're ready. They're still moving. We gave a short sale on the EURUSD for the live room here. A little scalp, nothing crazy. Just, a little food, a little taste. All right. All the bigger work is in already. Oops. 1, 2, okay, 3. 3. Okay, so what typically will happen is you get these 3 drives to end the swing. All right? 3 drives will typically end the swing. So triangle breakout, if it breaks out and is very impulsive, like I'm talking real sharp impulse up, you tend to get that. All right? See, look right here, guys. You see this right here? That right there and this right here, that's what's called a divergence. You had higher high in price, lower high in the oscillator. Okay? However, when you're breaking out from a triangle and you have a real breakout, you don't want to get out until you start getting these 3 drives. Once you start getting that third impulse up, then you start exiting. Now, that's also a disclaimer. That first big move out, you're taking money off the table. But to clean up your trade at the end, that's where you have your third drive. And then you're looking at the big corrective wave. And then you're looking at the market a little bit differently. And this is, look, I've been looking at the markets long enough. This is what it does all the time. All right? Then you have this. Up, down, and that's where you create that first bigger retracement. So you first move out. So you got it, guys? You got it? We're all on the same page? We're all on the same page? I thought we'll do a class, maybe 15 minutes. Okay, always the wicks. Always the wicks. Whenever you do charts, always the wicks. Do not do this. Do not do it through the body. Do not do that. It's always the ends, the highs and lows. Just like here, guys. Look, the wick. Okay, you see the wick? Always the wicks. All right? So let me save this. When trading Forex, we have to learn first about the type of trend we are in. For instance, we are looking at a chart of the USD CHF right here, and we will observe the types of trends. Now, I'm going to draw this out. An uptrend is considered a market that makes higher highs and higher lows. Higher highs, higher lows, higher highs. What does that mean? So this is a low and this is a high. This is a higher low. That establishes the beginning of a trend. This would be a higher high because it's above the prior high. And this is a higher low because it's above the prior low. So a series of higher highs and higher lows. In technical analysis, the move up has to exceed the prior high and the move down has to stay above its prior swing low. And that would determine a trend up. A trend down, and we'll change the colors of our little marker here, is
lower highs. So you have a high, you have a low, you have a lower high. And then it continues down to a lower low, lower high, and lower low. This is considered a downtrend. Now, a sideways trend is typically this, where the market goes sideways in a range with no direction. There is no higher highs, there's no higher lows. It's just basically sideways consolidation. Let's take a look at a couple of examples. Here's a downtrending market. We can see that the market went from a high to a low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Market went into a sideways range right there. And then we start again at the low. High, high, higher low, higher high, higher low, higher high, higher low, and it stopped going up. Then the market turned down, and you can see the same scenarios. And that's how you determine the trend. Here is evidence of a sideways range, a trading range, a sideways range, or a sideways trend. Here is a sideways trend. Here is a sideways trend. The market moved down. Wasn't much of a downtrend, but we did have from a sideways range. Typically, a market will expand out of a range in very sharp action. For instance, right here, the market did a fake out to the upside and fell. A lot of times that happens out of a sideways range. You may get a fake out and down, or just a breakout. It can go either up or down. So going from a downtrend to an uptrend, we have a low, a high, a higher low, higher high, higher low, higher high, higher low, higher high, higher low. And you could see that this is considered an uptrending market. It's not just if the market's doing this or that, it's you want to make sure that there's a series of higher highs and higher lows. We will look later on at an analysis or a theory called Elliott wave in our future videos. And essentially the market is made up of what we call a 5-wave. Low, or what do you call it, 0, 1, 2, 3, 4, 5. What we call a 5-wave. It's from a gentleman by the name of Elliott, and it's called the Elliott wave. So we'll have more analysis on that in the future in our more advanced videos. But for now, we have just determined and observed what a sideways trend is, an uptrend, and a downtrend. My name is Christopher Terry. I hope you enjoyed this video. My name is Christopher Terry, CEO of iMarkets Live, and I want to talk about wealth creation and really how it relates to trading, and also using the power of leverage and knowing when to use it. When we look at wealth creation, and we here in the network marketing arena, we're here in the trading arena, the power of compounding. And it's always that one example. If you took a penny and you doubled it over a period of 30 days, or you'd have 5 million, or 31 days, you have $10 million. So if you took a penny today and you doubled it each day, right? It doesn't look like much is happening, but you're accumulating. And the more you accumulate, it just starts to increase, and the power of compounding starts to kick in. Now, this is dramatic, and it's not obviously not theoretically real, but we do understand that the banks use the power of seven, which what they do is they take 7% a year and they compound it. So what we'll do, let me just show you. So the banks, when they do the illustrations, they basically look at if you were to compound 7% over so many years. So 7% and then 7% on top of that, and so on and so forth. And they continue to grow, adding 7% each time. And that's a fair number over a period of time. The problem with banks is they give out 1%, but they talk about compounding 7. As you see here, just in this little mathematical model, that the power of compounding, once again, where you're starting at 10,000 and over 31 periods later, it could be a month, 31 months, 31 weeks, 31 years, whatever the factor is, you can see how it just starts to compound and really gain momentum as it goes up. I'm using the number 31. Let's just say over a 2-year period right here. Okay, so let's just get rid of this. Clear those contents. So if we look at trading, and I know we're all traders and we look to make high amounts, and let's just use the factor of 10% in a month, which trading on leverage, trading Forex and futures, obviously there's a lot more money to be made. But let's just say hypothetically, you started out at 10,000 and each month you work to earn just 10% on your account. Okay, you can see how the power of compounding starts to kick in, and in just 2 years, you have yourself nearly $100,000, $90,000, just by growing it a little bit at a time. This could be weeks, this could be months, this could be years. It's all dependent on the person and how much they leverage. I want to speak a little bit about the power of leverage, and we see the power of compounding. All right, and in the world of trading, it's fun. It's great to have that kind of power. So the U.S. brokers typically give 50 to 1. 50 to 1 in the Forex market. And that means basically for your $2,000, you could leverage 50,000. Sorry, 100,000. Oops, right there. All right. Now there are brokers that allow 100 to 1. And you have 200,000, right? And then you got brokers that give 500 to 1, which really is not the best to do. You got 1 million right here. And then you got some of these brokers that allow you to do 1,000 to 1. And that gives you $2 million leverage on $2,000. So utilizing the leverage of the 50 to 1, we could see using $100,000. So let's just say you have a $5,000 account or $10,000 account. So let's just say you have a $10,000 account. Okay? Technically, you really have 50 to 1, right? So technically, you have 5 times, you have 500,000 of money you can use. Okay? So on a $10,000 account, you could technically have 500,000 if you leveraged it correctly, 50 to 1. Essentially, you're doing 2,000, which is 100 times 5, it's 500,000. But on a $10,000 account, let's just say you want to grow it at a rate of 10% in the month. Okay, 10% in the month. It could be less, it could be more. So during the course of the month, you want to earn, you want to use one standard, which is $10 per pip, and you're seeking to get 100 pips in the month. That's all you're looking for. So a couple of trades, you put yourself at 100 pips, and you have 10% in the month. Now, whether you get 40 pips, whether you get 200 pips, that's irrelevant. I'm just giving an example of what you can look at and in terms of targeting for your growth, and also do something on a conservative level that if you do lose a little bit, you still have plenty, still have enough money to trade. Of the $10,000, if you're doing one standard, all right, you're using, and just say you're doing the USD pair, you're using $2,000 of the 8,000. You're not of the 10,000. You're not using the whole 10,000. You're using a portion of it. Okay, and this is where the leverage comes in. All right, so I see traders, they'll have $1,000. Okay, $1,000 account with 1,000 times margin. They have $1 million, and they're trading 2 standard lots. And yes, they make, it's $20 a pip. They make 50 pips. They made $1,000. They made $1,000, and they think, "Wow, I did 100% on my money," but not realizing that if they lose those pips, all right, they're wiped out. All right, you wiped out your account. So the main thing with trading is you want to really be careful about losing or wiping out your account in any one trade. Normal is you start here at, say, 10,000, you go up a little bit, you come down, you go up over time, you come down, you go up over time, you come down. All right, so you want to continuously look at how things grow. I'll show you a track record in a little bit that we used for our PowerPoint video, and it goes through our wins and losses for the past 12 months, and it'll make sense. But what I'm seeing is, I chat with people all the time, and I'll see them go from 1,000 or 10,000 to go straight up like this. Okay? They go straight up. It's unsustainable. And then it's down, and they took their demo account, they reset it at 5,000, they started over again, and they go up, and they go down, they reset it again. And I would like to see long, sustainable growth over a period of time, and you end up compounding and create wealth, all right? Because you will have times where you have days, weeks, months, where it's just the market's just not going to do the right thing for you, all right? You're just not going to be on your game. It's human nature, okay? And to lever up every single time, you're better off going to a casino, all right? Or maybe you're treating it as a casino. You don't want to do that. You want to lever it up over a period of time. So let me show you something. All right, this is the one we use for our PowerPoint. This is from our live trade signal service, but it's just an example. All right, I don't mean to show you nothing, but it's just an example, and I want to point out something. Okay, we started in at one point with 10 grand over a period of time, but you see how you're going to have your winning streaks. You're also going to have times where you go sideways, even down. And then you have those times where it just continues to grow. It's over a period of time. All right, I'm human, and I have my losses, right? But I can have a string of losses and still maintain a safe growth over a period of time. This is a real track record because I know I see some of the stuff on the internet where, 0 to 6,000, and you just have to question yourself. But over a period of time, there's nothing wrong with making a bunch of pips, okay? Let me just fix this here. Let me just fix this. There we go. All right, down here, over a period of time, pips. So, although some people may look at it and say, well, it's only so much. Well, the difference is we're in the game a year later, all right? And, you could do multiple times that. The factors, that's not the point. The point is you do not want to leverage. We're using 1 to 3% risk on trades. So you're growing it. If you're taking your losses, you're keeping them small, and you're growing it over a period of time, you're going to have long-term sustainable success. That's a normal track record. Wins and losses over a period of time. Not, just getting in and losing. So I want to talk about size. I want to talk about trade size. I want to get into that and show you some thoughts. Okay, one of the things that you want to look at when you are trading is that, let's just say you have an account, $10,000. It could be $1,000. It doesn't matter. All right, and you have your 50 to 1 leverage. So you have 500,000. All right, and I know some of you are probably thinking, oh, I can go to this company and get all this leverage. Let me show you something. I'll use this company for an example, and this is a great company, Traders Way. They're a great, great company. A lot of traders use them. They have great leverage, and leverage should be respected. Okay, leverage should be respected. I'm going to get into an example of how to maximize yourself with leverage, but you want to respect it. So when traders look at this, newer traders, they look and they think, wow, I can get 1 to 1,000 ratio. That means my $1,000 times 1,000 is $1 million. So for $1,000, I could leverage $1 million. And that's true. Okay, you physically have it here. They give you the leverage. You can physically do that. All right. Minimum deposit. There's no limits. They got great spreads. Okay. However, the one thing nobody looks at is, let's see, risks. See that right here? New to the market, risks. And you scroll down, and they talk about your risks. They talk about the power and leverage. They talk about if you had a 100 to 1 leverage, that you can leverage the EUR USD, which is normally 3,000 on a 50 to 1, right? But with 100 to 1 leverage, you can do it for 1,400, and literally on 1,000 times, you can do it for 140. But in little writing at the bottom, observe capital management rules. It says it right here. So let's think about this. These rules aim to restrict losses on any given position. Most importantly, your losses should be no more than 2% of your deposit. So if you have $1,000, $1,000, your risk should be no more than 20 bucks. Okay, so you ask yourself, wait a second. They're telling me I have 1,000 times leverage, or 1 million, but I can't risk no more than 20 bucks. That's silly. You have to ask yourself, right? That's only like 2 ticks on a standard. I can do crazy standards. Well, there's reasons for this. All right, and I'm going to go into this. I'm going to explain a little bit more on how to use leverage, on how to maximize the power of leverage, but not abuse it. Abusing it means you start your account, you got $1,000, and immediately you're buying 2 standard lots. You're $20 a pip. You lose 20 pips, you're down for 100 bucks, and now you're out of the game. You work so hard to get your money, and in a few pips, you're out of the game. But if you have some successes right away, you feel like a genius. I took $1,000. It's worth $5,000 now, or $3,000. Yeah, but what if you start losing? That's the thing. So Traders Way, who gives $1,000 leverage, says don't use more than 2% of your deposit. Don't risk more than $20 per thousand. So when I tell somebody we risk 1 to 3%, they laugh. I had somebody laugh at me. Oh, that's silly. Okay, that's silly. I'm in the markets for 20 years. All right. I've created ridiculous amounts of money, fortunes. And here's a guy who doesn't know anything is telling me that's silly. Yes. Let's go back to that spreadsheet. All right. Let's go back to the spreadsheet. All right. A little bit of growth, a little bit each time can lead to massive amounts of wealth. All right. Realize that. And you also want to restrict, even though the broker's telling you, you have 1,000. So what they're saying is, we're going to give you a rope, and it's up to you not to hang yourself. My father used to say that when I was young. Son, I'll give you all the rope you want, but you get sloppy, you're going to hang yourself. And of course, I was a kid, and I didn't know what that meant until I hung myself, and I got in trouble, basically, and I had, he grounded me and all this stuff. I'm 49 today. I was talking when I was a kid. I want to show you really what you can do with leverage. So let's just say you have a $1,000 account. A $1,000 account. Now, because you have $1 million, doesn't mean you have to eat up the 1 million. So you're using 1 to 3% risk. Okay, 1 to 3% risk. That means when you take a trade, let's just say the trade is 30 pips. 30 pips risk. We have another one for 50 pips risks. And we have another one for 100 pips risk. And let's just say we're going to risk 1%. Okay? For argument's sake, 1%. So, even though you have 30 pips risk, okay, my marker here, you're going to risk $10. All right, $10. $10. That's your risk. All right, and those of you that are looking at this going, but I got 1,000 cash, $10 is nothing. You're not getting the idea of how to create wealth. You're getting the casino mentality, and we know what happens at a casino, right? Everybody who comes to a casino leaves broke. Your goal is to create wealth, not leave broke, not put all your money on the table at one time, because you will lose. You will have losing streaks, and professional traders look at losses first before gains. So let's start with the 100 pip risk. 100 pip risk at $10 means you're going to use 0.01. You're going to use 1 micro. 1 micro lot. Okay? 1. Here, you're going to use 2 micro lots. And here, you're going to use 3. 3 micro lots. All right? So, 100 pips. So you got standard. Let me just get this so you understand it. There's 1 standard, 1 mini, 1 micro. Okay, so when you look at MetaTrader 4, that's a standard. This is a mini. This is a micro. Okay? So a standard lot, if you risked 30, let's just say 100 pips, 100 pip risk, 100 pip risk is $1,000. Can't do that. If you risked 100 pips on a mini, this is $100. That's 10% of your account. Okay, this is 100% risk. And 1 mini 1 micro, 100 pip risk is $10. So essentially, if you say I want to risk the maximum 3%, okay, you just triple the numbers. This would be 3, this would be 6, and this would be 9. Okay? And this would be 30, 30, 30. And you would not have it account if you risked 3%. You did exactly this, right? So, what we look at as professional traders is you want to maintain that 1 to 3% risk, and Trader's Way is essentially saying 2%, and I agree with that fully. But we still have that 1,000 times leverage that they talk about, right? It's still sitting there. Well, how do you use that? Let's talk about it. Let's talk about how to use the leverage. Let's look at some charts for a minute also. Let's look at some charts. All right. So, let's just say you got into the market. Oops. Let's just say you got into the market right here. Right here. Okay, right here. You got on for a short sale. Okay. You risked 1% on your account or 2%. It doesn't matter. And the market went down in your favor. So now the market is down here. All you're doing is now you're bringing your stop loss here to break even. So trade 1, you did a sell short, and the market went in your favor, right? So now you had a 2% risk, hypothetically. And now the market went down here, and now you move your stops to a little bit under break even. So if this was your entry, you now bring your stop. So essentially, you have 0 risk, right? So now you went from 2% down to 0 risk. So essentially what you did was you started off with small risk. Market worked in your favor. Okay, let's just say it worked in your favor. And forget about that it went back up. The fact is you broke your stops to break even. You now have 0 risk on the table. Okay? 0 risk on the table, and you're short the market. Well, that's fine. So you're saying to me, Christopher, okay? Chris is saying to you, wait a second. You shorted the market here. Let me see if I can get a better, oops, I did something wrong. There we go. Shapes. So, is it me or I can't seem to make this thing work? Okay, shapes, eclipse. Okay, we're gonna continue to work with this, work with what they got. So we shorted the market right here, and now the market is down here. This was your entry, and now you bring your stops to right below break even. So what you've done was you brought yourself down to a goose egg. No risk, okay? Now remember, you still have a position on, right? You still have a position on, and you've eaten up a percentage of your margin. All right, so standardly, basically, you've eaten up a percentage of your margin, which is decreasing your free margin. So if you started out with 1,000 and you used $20 or $100, $50 out of this, whatever, you now have $950, what they call free margin, which means that you're in a trade, you have 0 risk, and you still have all this margin to use. All of that. That means that you can look at another pair. let's just use this. Let's take a look at this. So you say to yourself, wow, I could trade. This is my harmonic scanner from the company, actually. Okay, this is a harmonic scanner from the company. So we look at it and we say, okay, 2% risk is $100. All right, this is on a $5,000 account. Here's your risk. Here's your entry. And let's just say you actually took this trade. Okay, you're right here in the trade, and your stop would be break even right now. Okay, so essentially you're eating up a little bit of margin, right? You're using 0.67 lots on 5,000, but right now you have no more risk, so you can go to the next trade. So if you look at your portfolio, you can have a list of trades. You could have the EU, EUR. You can have the JY. You can have the GA, GBP, AUSD. But as you start to profit and you bring in the risk down to zero, all right? As you're bringing the risk down to zero, meaning if you would have shorted it here, the market's here, you've got zero risk now because you break even. You are eating up your free margin. You're eating this up right here. And this is decreasing. Because now if you did a trade, for instance, a 0.67 on this, you would be eating up all that free margin. So let's take a look. Let's take a look at the videotape here. See if I can open up the terminal and show you. Let me just do 6.7. 6.7. All right, so let's just say you did. Okay, I may have screwed something up here, so hold on a second, please. Okay, I see what I did. I turned it off for this account, so. All right, no big deal. So anyway, the point is, you have your trade you entered here. It's come down this far, and you have a break-even stop. Essentially, you have zero risk on the trade, but you're eating up your free margin. Some pairs have higher risk than others. The EUR CHF, since it's the CHF, there's a higher value attached to it in terms of margin and risk. All right, I'm using this as a demo account that I'm using here, just to show some example. All right, let me just fix this. All right, so that's how, when we look at trade margin, that's how professional traders look at it. Trade one, okay, you do the EU. You do 2% risk. And when the market's in your favor, you have a break-even stop. You have zero risk. 2. EJ, okay, 2% risk. All right, and then when it comes in your favor, you have 0. You can either take the profits off the table, or you can continue to add positions. So when you're looking at free margin, because you have $1,000 in an account, you have 1 million free margin. In the U.S., okay, most of the brokers, you have 1,000, you have 50,000. All right, you have 50,000 in free margin. All right, so that's where the limitations come. If you were to do multiple positions, for instance, this one may cost you so much margin, this costs so much margin, and every time you do a trade, it lowers your free margin down. All right, it lowers your free margin down to lowers it down. So you're able to leverage. You have cash, and then you have your leverage money. Every time you put a position on, it takes away from your cash amount, your margin money. Okay, so you want to keep that in mind when you're trading and you're using leverage. You don't want to come in and put a heavy position on your cash. So what Trader's Way was saying was that, yeah, you have 1,001, don't risk more than 2%, but that 1,000 can be utilized over multiple positions as long as you keep in the overall risk. small. And how you're doing that is you get a position that's in your favor, you bring your stops to break even, you add, and you could build up a portfolio. Maybe you like to trade 4 or 5 positions. All right. So rule of thumb: 1 to 3% risk per trade, and 2 is no more than 6% on a combination of trades. All right. So if you get in the game and you're winning, you're doing a little bit of losses, okay, over a period of time. All right. It happens to me. I get in, I may take a couple losses in a row. Big deal. Because you're keeping your risk so low that over the bigger picture, it doesn't matter. All right. It really doesn't matter. It's that when you lever up on your initial positions, that you could put yourself out of the game rather quickly. So always prepare that you're going to have a situation where you run into a streak of losses. It just is what it is. But you want to put yourself in a position where you're going to run into a streak of wins. And that's where you start compounding your money. All right. I hope this helps. I took about 30 minutes just to discuss margin, leverage, risk, multiple positions. And if you want, just watch the video over and over again. And I hope it makes sense to you. My name is Christopher Terry, CEO of iMarkets Live. And if you have any more questions, just reach out to the person that introduced this video to you and see if you can get your questions answered, or email us at trade support at iMarkets Live. Thank you.
All right, guys, I just want to go over something that I think is a good idea. It'll help you trading going forward. There's things called flags. There's pennants, flags, and typically a flag would look like this, okay? Market went sideways. Market went sideways, and then, let me just fix this. You have this breakout from what we call a sideways line. See, when you have all these bars going sideways, that's called a sideways line. All right, just basic. It's basic technical analysis 101. From there, typically you would get a breakout. From there, you will get a pullback. Okay, these pullbacks are called flags. All right, they look like flags. Okay, they look exactly like a flag. They're also called continuation patterns. So the market rises. Okay, so these are called continuation patterns. Breakout, you got a retracement, and then continuation. Okay, here you see the market once again went through this sideways line, started rallying. Okay, actually still went through the sideways line, this whole sideways line. Market rallied out of that straight up, right? Market gave impulse to the upside. It is now forming another flag. You can see this. This rising flag, as I said earlier, and I know we got new people that are just coming in, this rising pattern is very bullish, okay? Very bullish. Now, if you were to trade this, your stop would be under here, okay? When you're trading this, you look at stops underneath where it broke out from. So this right here is very bullish. This leads me to another thought of market profile, okay? A thing called market profile, market auction theory, or auction market theory. So the markets, they trade as if they are in some type of an auction, all right? So when they're down here, right, they come out of here like this, and everybody's agreeing on the price. Like right here, would everybody agree? Everybody agrees on the price, all right? Everybody's agreeing at 1.0841, that's the fair value. That's a fair number. That's the fair price, okay? Everybody's agreeing. Buyers and sellers are all in agreement right here. All right? They're all in agreement. So, okay. Everybody's right in agreement right here with price. Everybody agrees. The buyers and sellers both agree with price. So, what's he talking about? Okay. All right, guys. So, yeah, no new trades going on this weekend. So, since everybody agrees to the price, you are in what's called a sideways line. And what happens is it creates this value area. This is where everybody's comfortable, right in here. Okay, this value area. Value area is created like this. So let me take some Fibonacci. All right, let's just have a little fun here. Okay, let's say this is 30% and this is 70. That's 30. This is 70. Okay, and this right here so just, follow my thinking for a bit. So you have markets that go into ranges. And you see it, right? You see this. Markets go into ranges. And we have what's called the value area. This is the value area. This is where most of the action has taken place. All right, so right in this zone, I'm sorry, and I did this wrong. I got to fix this. Let me just fix this. My bad. Hold on a second. Sorry about that. There we go. Oh, I can't even do this right now. Okay. This is where 70% of the action has come from, okay, going forward. So the middle of this is called a point of control. This is value area. This is where the market feels. I'm doing a video. Okay. So this is where the market feels that it's a fair price in this zone. All right? It's a fair price. From that, let me just erase everything. Just so you know what it looks like and what the reasoning is. Just right here. Same example. Okay, so let's start again. Okay? Just so you guys all on the same page with me. Where 70% of the main action has taken place. and this is called a point of control. All right? Point of control. And this is why just following the market's actions will keep you on the right side or keep you on the wrong side, right? So let me just scroll over. All right. Scroll over. We're just going to look at this spot right now. So this is an area that the market felt was in agreement. This is where traders, little traders, younger, inexperienced traders get hurt. Traders get hurt, okay, because they're trying to guess the highs and lows. They're trying to guess all this, okay? And all this stuff here, you see all this? This is all faking out members or people, I'm sorry. This is all fake outs. Okay, this is how when it starts to break out, you're thinking, oh, it's going higher. So what they call a fake out breakout. All right, that's a fake out breakout. Now, don't get me wrong. This push right here led to a retracement, led to a test back up. It failed to go further. It tested down. It tested up again and tested down. At some point, people were looking at, well, it's gone. This is the thinking. Ready? Watch. Market goes up. People buy it. All right. All the big players, boom, buy it. They're out. The smaller players thinking this is going a lot higher. We're going to get a measured move up. And it fails and brings them back to this area down here where traders think, well, I got to short it. We're in a range. And it grabs them and drives them back up again. And they think, that's it. We're breaking out again. And it drives them back down again. Now, at some point, they figured out that, well, if this was a buy and this was a sell, and that was a buy and this was a sell, this got to be a buy, right? So, and this is how the thinking is in the markets. So they buy it, and then the big people drive it lower. The big money drives it lower. Bang. You see that? Then you get, from that point, we all know the process. Pull back, so drive 1, drive 2, drive 3. 3 drives down. You see that? So we all know, and we discussed this before, 1, 2, 3 drives down. And you're right, Mark, if it wasn't for big money, what we call smart money, if the smart money, if it wasn't for them, you'd be sitting in value areas all the time because the market would stay in agreement at all one time. But it tips to one side. The market tips to one side. It's similar to, you have that game. You got the participants here. You got participants here. And then you got the knot, tug of war, right? At some point, it's going to tip to one side and everybody's going to flip over. Everybody's going to flip over. So it's similar to like tug of war. Big money's buying. All the banks are buying. All the banks took position, So now everybody's in agreement. All the big money, the smart money says, you know what? We're going down. We're going to go down. And we're going to drive them down. And we're going to drive them down. But now this is an area that used to be of value. Okay? This area used to be of value. Right in here. Oops, sorry. So lower value area, upper value area, control point. This area used to be at value. So market likes to attract. I'm just teaching right now, Diego. I'm just teaching. Market likes to attract to different value areas. You can see right here. It attracted in here. Okay. All this. You can see when the market came up, when it broke back above here. Okay. This is considered value area. And you can see right here, look, market hit it, backed off. Market hit it again, got above it, and exploded. Why? This is support, resistance. It's just, you can see it right there. It's evidence, okay? Market stopped going down, and bang. All right, once it got above. So this is value area. Market went out of value, rally up, boom, 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 back to value, out of value, drive, 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 done into value, right? I'm taking you through the sequence. So all this from the past is relevant, okay? All this from the past is relevant. This is why I'm always looking at the past, at what patterns have done. It's all relevant. Even right here, when this hit, look at that. When this hit here, it was hitting this, but it just broke out of a long sideways line. Longer the line, the longer the drive, okay? Longer the line, the longer the drive. So now, market has now gone up. A lot of impulse. Everybody wanted to buy. Auction market theory. So they all agree that 810 is good. 810 is good. And in the thinking of if we were on the cattle range, I know one of our guys here is Scott. I'm not sure if Scott's on with us this morning. I'm going to beat him up if he's not with us. No, he's not on. So he owns a cattle, right? For instance, you know, they bring cattle to the auction or a car auction. You guys see the car auctions on television, and you're getting this. And this is how it's actually reading if somebody was doing an auction. 810, 810, 810, 812, 812, 812, 812. Anybody buying at 816, 816, 816. Anybody buying at 812, 810. All right? 811, 811. How many times are going 811? Down to 807, 807, 811, 811. Back and forth, back and forth, back and forth. And it's bidding 810, offering 810. Bidding 810, offering 810. Bidding offer 809, bidding 811. Bidding offer 9, offering. Bidding, offering. Bidding, offering. You see? Everybody's in agreement right here. Everybody's right here in agreement. And then also, bang, it starts going. They hear 815, 815, 815, 821, and they start going up like an auction. So that's what's happening is a crowd mentality is everybody's trying to get on the side where everybody's starting to go. But if you think of this in the auction theory where they're actually reading the prices, since it's going sideways like this, it's going like this. 8-9, 8-9, 8-10, 8-10, 8-9, 8-09, 8-11, 8-09, 8-11, 8-09, 8-11, 8-09, 8-11, 8-12, 8-12, 8-13, 13, 13. Everybody got 13, 13, 15, 15, 18, 19, 19, 19, 17. Do I hit 18? Do I get 18, 20, 20, 20? So it starts picking up. The volume starts picking up, and the auctioneer is going, do I hear 24, 24, 24, bid 24, 24, 24, offer 26, offer 26, offer 28, sold, okay, right here, sold. But it's that crowd mentality. I can't really do it that fast, but become that crazy auctioneer, and it's driving the market up. And it comes into that resting period where the markets have broken out, and they all come and they rest. They all start selling, and then they're buying again, and now they're going back into the area of value until somebody says, I'll bid 35. And somebody says, okay, I'll sell it to you at 35. And somebody says, I'll bid at 30. Somebody says, I'll sell it to you at 30. And they start selling it. And before you know it, everybody's gone. Nobody wants to be there anymore. And they're trying to sell it. They're just selling it. Nobody wants to buy it. And they're just selling it. And they're back down to the prior auction price, that prior value where everybody was content with agreeing on the price. And once everybody agreed that this price down here was the bottom, you can't stop it from going up because now everybody wants to be in. Everybody wants to be in. And most of the time, and so you see this, if you see the way the price action is here, everybody's not really so, they're buying and selling. But it's when you start to get a little bit too far that everybody wants to be in. Right? iMarkets Live went sideways for a while. And all of a sudden we started getting attention. Right? Or here, we started getting attention. Went for a year worth of attention, growing. And all of a sudden it's like more. And all of a sudden now I'm getting calls from master distributors. I'm getting calls from company owners. All of a sudden all the big people come in. Everybody's to be in iMarkets Live. And at some point it's going to peak and go sideways. That's just normal. It's normal course of business on any instrument, any market, anywhere. So you see what value is. Then you go back into what's called that sideways line. Sideways line. Okay? I'm just using I hope iMarkets Live doesn't go sideways. I hope we go up forever. But you got to be real. Okay? Every company goes through growth and sideways and down and up. And we went through enough down over the past couple of years, and we went up pretty good. But so you've gone sideways long enough here. I don't know if I use iMarkets Live as an example, but whatever, it doesn't matter. The point is you guys understand. So you've gone through this sideways line, this extended sideways line, and nobody wanted to take control of one side. They brought it down here by trying to sell it, and they got stuck because they tried to sell it out of the range, and the buyers took it back up. And when they got up here, the sellers came back in control. And then the buyers took control. And then the sellers took control. And the buyers took control. And the sellers took control, and the buyers took control, but the sellers couldn't push them down too far. And you had that first little flaggish, but you had a big range here, right? And then the buyers came back in again, and once they came above, everybody wanted to be in. Auction market theory. Okay, auction market theory. Okay, it's the auction market. This is the theory. Everybody wants to be in. It's went sideways so far, it needs to go up, right? Then it goes sideways again. It goes sideways again. So until it gets above here, until it gets above there with impulse, let's just say it goes like this, and like that. So until it goes outside of it, you're still going to sit in what's called a sideways line. This is where most people get hurt. I don't like looking for markets that are in sideways lines. However, I do like looking at markets that are like this, that are forming particular patterns, where maybe a harmonic pattern is something. Harmonic patterns are great in ranges. Harmonic patterns are great in ranges. They're also great when the market does this, okay? And you're in an uptrending environment, and it forms that bullish pattern. Or if you're in a sideways environment, right? The market's been going sideways, and it does like this, okay? Okay, and what had happened was you're forming ranges with the market above. So two ways to look at harmonic patterns. One is in a trending environment, and another one is in a range environment. You see? Hector Seda, welcome back, man. Mark was telling me you weren't feeling so well. Hope you feel better, brother. All right. So anyway, this is what's called auction market theory. These are unfair lows, unfair highs. This is, they got all sorts of little terms for this. But this is how auction markets work. And if you understand the trading environment, this is how trading works. You're looking at it as patterns, but the market thinks in terms of auctions. It doesn't think that you got this bull flag. It's just a natural occurrence from the auction market. So when you're looking at something like this, market rallied up, and now it's getting that consistent, it's holding, and it's forming that this sideways line came out. It's now forming that consolidation because everything's out of the range now. Now it's starting to consolidate and the buyers are starting to accumulate. As it starts to accumulate, we're going to start seeing better impulse to the upside. So I thought I'd share that with you. It's a little class we did here.